Patrick, we had a rather random but painful, let's call it, stat earlier in the show. The S&P 500 is on pace for its worst first half to a year since 1962. Can it get any worse?
Well, I think right now it depends on where you think the economy is headed. We believe that a lot of the valuation correction we've seen in the market has taken place because we have rising interest rates, we have widening credit spreads, and we have elevated volatility. So I think the question then becomes is if we get volatility to heal, we believe stocks can rally from here. But I think the flip side to that question, though, is if you think we are headed into a recession, we don't actually think markets have been pricing recessionary risk up until about the past week. So there could be another leg down if you believe there's a recession, at least over the near term. But we don't necessarily see that on the horizon, perhaps over the next 18 months. So we think stocks have an ability to move higher here.
Yeah, and you know, recessions matter because earnings come down. So what is your earnings model? What is it, $200 in total earnings on the S&P 500? It's 16 times earnings. That gets you to a 3,200 price objective. Where do you guys stand at Credit Suisse on earnings and valuations?
So for earnings, we're looking for this year at 235. That's up around 10%. 2023, we're looking for 255. And I think what's important is that's also 10%. Corporate profits remain quite healthy because companies benefit from a nominally strong GDP. So that means they benefit from inflation because they have fixed cost leverage. I think the debate is what do you put on it for a multiple? And right now, our expectation for a multiple is to move something back towards the range of 19. We're about 16 and a half. And we expect that to take place over the back half of the year. And once again, it's as we see volatility come down, we believe multiples can move higher. That said, you know, if recessionary risks pick up, then I think earnings have to come down. We're not seeing it right now in the estimates. We're not seeing it when we talk to analysts or we look at analyst dispersion. So how uncertain analysts are, they seem to be fairly comfortable with their estimates. So right now, we don't think we have the same recessionary concerns that I think a lot of investors are actually focused on.
Those are pretty big numbers, Patrick, that you're still seeing earnings grow. All we hear about is recession and doom.
Well, I think what investors are focused on is the deceleration of economic activity. And let's be clear, we're coming out of an economic bounce, and we are decelerating on a real basis. So let's not take that away from the conversation. We're decelerating from an extremely high level and moving to something that looks back towards trend growth. So investors are, I believe, over extrapolating the pain that they're seeing in this deceleration. And they're saying, well, we're going to head towards a recession. I think when you look at labor market conditions, when you look at industrial indicators like industrial production or ISM PMI, you see a backdrop that remains quite healthy. And even retail sales have continued to hang in there. So when we look around the landscape, we don't necessarily see the same recessionary concerns, and therefore we don't see the same concern to the same risk towards earnings right now.
20 seconds ago, leave us with an investable idea right now, Patrick. Something's got to look good. Anything?
Well, I would continue to have investors focus on commodity-sensitive areas. We've had a little bit of weakness in oil, but ultimately we're in an environment we are supply-constrained around commodities, and ultimately that's going to be the area we're going to see a lot of fixed cost leverage and a lot of upside to profits.